Everybody, this is 𝙁𝙁𝙁𝙄𝙇𝙄𝑼𝙍, your host with the Freedom Report. It is Wednesday, January 15th, 2025. I'm still getting used to saying 2025. It just takes longer than normal when you get into a new year. But we are in the new year, and this is going to be a gold and silver focused report, probably the first big one of the year. I think you guys are going to be interested in this. I'm going to hit you with so much data. It's going to be data heavy, super geeky type of deal that I typically do. And then tomorrow, for anybody wanting to visit, actually Friday, Saturday, we'll be down at the Houston Money Show. If anybody's interested in speaking to me there, it's basically a coin show or bullion show, if you wish. Other things like money and notes. I'll be down in Conroe, Texas, there at a table for Kinesis back in sort of the back left-hand section of that show. So if you're interested, join me down there this Friday and Saturday if you're in the Houston area. All right, without further ado, let's jump into all the data. I got a lot to do and not much time to do it. Got an upcoming interview behind 𝙁𝙁𝙁𝙁𝙁𝙁𝙁's show. So let's roll through this real quick and get you all the data that you didn't know that you needed or that you wanted to listen to. And I'm borrowing a lot from other people's exhibits, as you can see here. These are some charts I've made, some charts other people have made. We'll give full credit to those. We've already done that on Twitter, but we'll do it on the video as well. And I just want to run through a bunch of different things that are going on. So this is going to be, this episode in particular is going to get you launched into 2025, expecting the likely credit events and events in the gold and silver space that are likely to happen so that you guys can, understand what's going down in the system. So I posted a tweet yesterday and pinned it to my feed, basically saying what's going on with gold and silver, when are they going to break out? And obviously I had my opinions on that, but I just wanted to see what the community thought. And I did that, and people were like, a couple of people were like, aren't you supposed to be telling us? Well, yeah, but I wanted to see what you guys thought. And then of course on this video, I'll give you, my opinion on that as well. But that was, 45,000 views in less than 24 hours. Because that's the question the community, certainly my community, wants to know, and the precious metals community wants to know. When are we going to have the breakout? Well, I give you some data on what's going on in the market, and we'll speculate a little bit at the end of when this may break out. First, we got to get to the economy. So we're actually going to start with China. So this was originally posted by Finance Law, as you can see the credits given there on the screenshot on Twitter. And he's talking about the Chinese government bond 10-year yield just absolutely crashing in a very short period of time. You can see that dating back to a high right here, at about November, the 10-year bonds were trading at almost 2.2%, and now they're down to about 1.775. That's about a half a point or a half a percentage point crash in a very short period of time. What's going on with China's 10-year yield? Where you have deflation. So that deflation in their economy and the deflation in the world economy is starting to affect the bond market and starting to crash it. Now, why is China's going down, the U.S. going up? Well, the U.S. is going up because everybody's fleeing to the U.S. and driving rates up. That's actually bad because that eventually will crash the U.S. treasuries if we keep going up because we can't afford the debt service. It's just a temporary flight to safety, but the safety will go in a couple of stages. You'll go into U.S. assets like the dollar and into U.S. bonds, and then when the real panic happens, you'll go into the ultimate safe haven assets, which are the metals, which is a preview of when they may break out. Now we're getting closer to it. Everybody says, oh, we've been getting close to it for years. Yes, we have. But now you're starting to see it pop at you in your face in the data, bat, which is why I'm doing a chart-driven video today. I'm not doing my normal gold and silver analysis. I'm just doing some charts to express to you over the medium term, over the next 6 to 12 months to 2 years, something like that, what we expect to see. And then I'll get back to my regular point in time gold and silver analysis as we go forward. But anyway, I thought this was an interesting chart. He follows it up with the 10-year yield over a greater period of time dating back to 2005. So we've seen Chinese bond yields go from over 5% down to about 1.75. That's definitely an issue. It's an issue because it says that the creditworthiness of Chinese bonds is not great because their economy's not doing so great and they're deflating. And think about what China is. It's an export-driven economy, which is they're trying to move into, much like what the U.S. had, say 20 years ago, in which they had a producer-based internal economy where they buy their own things. But really, in large part, they're still an exporting economy. And as the rest of the world starts to decrease the demand on China's their economy is crashing. We saw the real estate crash in the last couple of years. We're starting to see a lot of their stock market. We've reported on that in the last few weeks, a crash in the large Chinese stock market indices, and now you're starting to see it in the bond market. It's just an indicator of what's happening in the worldwide deflationary economy because people buy from China. So when they start to crash internally, it means the rest of the world's already started their downward trend. They're not demanding as many goods. They don't have as much money. And so that affects China. So China is set up for a pretty big crash going forward. Again, we've seen it in the real estate markets, their stock and their bond markets. We've seen it in some in their currency as well. So not looking good for China, but that is a canary in the coal mine or a bellwether, if you will, or a milestone or, a stick in the ground, if you will, for what's coming to the rest of the world. Because as China goes, their economy goes, that's a sign of what's already happening to all of their trade partners, specifically the West, and their demand and how they've been deflating in their demand as we go forward. Here, we're moving over to the United States. This is Federal Reserve Consumer Credit Revolving. And you see a big crash here right over here on the right side of the chart. And that's a straight up and down line. The last couple of times we had a straight up and down line was one, basically the economic shutdowns and I'll call it the health scare to avoid the censors in 19 and 20. And then, of course, you look at 2008, you had a big crash. And then 2001, you had a big crash. So every time we have a recession or an economic crash of any type in the United States, consumer credit precedes that. And as consumer credit starts to fall, you get into the recession. This is yet another recession indicator that I'm showing you, and another big crash, which means consumers cannot spend. And when their revolving credit falls and they start paying it off, but really they're just using less, which is what this chart is showing, it means they can't buy stuff, and it's 72% of the economy. So much like we can see the Chinese economy quickly decelerating into inflation, that's in large part because the U.S. consumers decelerating their purchases. And what are our two main trading partners? Europe and China, and we've got others certainly. But that's an indication of worldwide deflation. So we move over to, I gave you a real quick preview there. According to the FDIC, the unrealized gains and losses on investment securities. I showed this a couple of months ago. I want to bring it back up again because if you look at unrealized gains on investment securities, it affects what? Corporates and banks mostly. It affects things like pension funds and 401ks and consumers, because this is all going to reverberate around the economy because we're all incestuously invested in all of this Ponzi bubble asset, junk in the system. But look at these numbers. There's nothing remotely remote on this chart dating back to 2006, remotely close to the unrealized losses that have not been officially realized. What does that mean? It means as the value of the debt securities and as the value of these stocks goes down in the economy, their unrealized losses, everybody on their balance sheets are saying, oh, this is the value of our stuff. And it hasn't collapsed these individual banks or these individual funds or these individual companies just yet. But this indication on the right-hand side of the chart, everything below the zero line is telling you how big this crash is going to be. Now look at 2020. Now look at 2007 to 2009. This is a monster crash because when those losses come due, it's going to evaporate the value on banking balance sheets, corporate balance sheets, retirement funds, municipalities, which I said they're dealing in adjustable rate debt when I was on Capital Cosm, and I said because municipalities are doing adjustable rate debt, and when that crashes and they can't, the interest rate spike and it crashes in municipalities, at every level of the system, it's going to be a monster in your face like we have never seen before crash. This time it's different. It's not different in why it's going to crash. It's just different in how damn bad it's going to be. And if it's going to be that bad, what's going to happen to the metals? Preview what we're going to talk about here in a few minutes. Look at that right side. If no other chart I've shown you the last couple of months doesn't get your attention, look at this one. Look at the unrealized gains and losses compared to history. And look at the Great Recession. It dwarfs the potential losses in the Great Recession. All that money printing just to prevent that. Well, now look at what's happening because of all the money printing and the Ponzi value or lack of value of these assets, these stocks and these bonds junked up in our entire system that everybody owns. Even the people own them. This is going to eviscerate value in the economy. Let me sum that by saying this is going to eviscerate value in the economy unlike any crash we've seen in modern times, period, end of story. At the same time, China is taking a big dump as well. And at the same time, people in the United States can't even buy goods and services. The whole world is seeing this. Oh, but I've got another chart for you. Here's the S&P 500 forward earnings yield. I believe this is also posted by Finance a Lot. S&P 500 forward earnings yield. That's a stock yield compared to the Treasury. It's crashing. Stocks are crashing compared to debt. Debt yields are going up. Why? Because everybody's fleeing to them, which is driving up in interest rates, which will have the effect of crashing the economy, because the government can't pay all that, by the way. It's going to literally eviscerate the economy, and it's going to bankrupt the United States government. But in the meantime, the milkshake theory is everything comes to the U.S. first. It bids up the dollar. What's happened to the DXY? It's been going up. Okay, even though temporarily it had a retraction, overall in the chart the last few years has been going up. Okay, even though in a bigger cyclical downtrend, really dating back to the 80s, I showed on that chart I think last week. So US people are going to US dollars, or going to treasuries for now temporarily until that crashes, because every time you do that and the bond yields go up, the treasury yields go up, it just bankrupts the government further. It just makes the problem worse. This is why it happens in waves. It reverberates throughout the economy. It affects different sectors. It's affecting China. It's affecting Europe. It's affecting the American consumer. It's affecting credit. It's affecting unrealized losses, which are going to collapse the banks and going to collapse the corporates. And then eventually the rising interest rate is going to collapse the U.S. government, where they go into default or they have to print money. And guess what? They're going to print money, because that's what they always do. Every government in history is going to print money. You're going to have hyperinflation. We're leading up to it. We're getting to that Minsky moment. We're getting to the crack up boom, the collapse, whatever you want to call it. Whatever term you want to use, we're getting there. And the S&P forward earnings yield basically says the stock market's out of gas, baby. It's out of gas, and it needs to run by Quick Trip so it can put more gas. But there ain't no more money to buy the gas from Quick Trip, so ain't going to have any more gas. So the stock market's just going to go doo 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 doo, and then eventually, bam, is what's going to happen. There's no more gas in the system, okay? Because the more money you print, the worse it makes everything. And this is the end of this fiat era Ponzi system that originally started back in the 40s, but really got going in 71 when Nixon took us off the what standard? The gold standard. What's going to do well when all this crashes? I don't know. What do you think? Fill in. It's a 4-letter word that starts with G and ends with D. Total revolving credit. Well, here we look at the total revolving credit of that said Federal Reserve. And as you can see, every time it spikes on this chart, boom, we have a big crash. There's a 2008 crash, and then it crashed, and then it came back up. And then you have the 2019 repo market crash, boom. And what did I say last week and the last 2 weeks on a couple of other shows and on my channel about the repo market? And I've actually been covering this about 6 months on my channel. But specifically, the last few shows in December, January, I've been really hammering on repo market, repo market, repo market. Why? Because in 2019, the repo market led to a big crash in the stock market. In 2008, the repo market led to the Lehman issue in the Great Recession. And guess what? We've run out of liquidity in the repo market because of what the Treasury market did. And we're about to have another credit issue and potentially a credit collapse, which is why the Fed has been cutting interest rates. Okay, because what they're trying to do is they're trying to do yield curve control. And that's why the Fed had to cut interest rates, because the yield curve control that had to follow behind it. So it didn't crash the system, but it's going to crash the system anyway, because we're running out of liquidity and nobody's got any damn money. And you look at this buildup in revolving credit at the Federal Reserve. Like any time in history, we'd think what happens when that crashes. What's that going to look like? Boom. You can already see the downward momentum on the chart. You can see it on the RSI. You can see it on the MACD. Crash city. The MACD's gone down to 0. What happens when MACD goes down to 0? Big crash. What happens to RSI? Tops out at 100 and starts to roll over. Relative strength indicator. Big crash. You see what's going on? You see the story? You see the data? This is data. It's not Rob's opinion. Look at the data. Every piece of data I'm showing you is showing you what's coming. And it's coming. And it's coming. And it's going to be big. And it's going to slap you in the face like a dead fish. And if you're not prepared, and the woeful thing about this is the majority of Americans, even though we've had warning after warning after warning after warning, are not paying attention. They're not financially educated because the elites try to make it difficult so they can't understand it. I, among other people that you know and love on YouTube, are trying to break it down and help you. But I can only do so much. I've only got so many subscribers. You know, Kinesis got so many subscribers. Mel Madison's got so many subscribers. Arcadia Economics has so many subscribers. TF Metals has so many subscribers. We all have so many subscribers, okay? But that's not 360 million people living in the US. And it's certainly not 8 billion people in the world. So we're all out here. Kudos to everybody I just mentioned and everybody else I didn't mention. Sorry, I didn't get to you. That we're trying to educate the public. But this is like a little drop in the bucket. Okay, you guys may be getting prepared. What about the rest of the world? Okay, obviously not, because look at the revolving credit. Look at what's happening in consumers. They don't know, okay? They don't know. So that's why the crash is going to come, no matter how many videos I do or how many videos collectively all the alternative media on YouTube and on Twitter and on Rumble and on Facebook and wherever you get your social media news. It doesn't matter how many videos we do. It's coming, okay? So now it's just a matter of, can you help secure yourself? Can you help secure your family? All right, I'm going to get off on that soapbox and we're going to, oh my goodness, look at the guys at North Star, bad charts. North Star has some of the best charts ever in the whole world. I'm so glad they're working with Kinesis on this. And this is a cool chart I saw on Twitter. This is a capital rotation event. So this is graphing gold basically to the stock market, the XAU and priced in dollars to the stock market. And you can see when gold breaks out, boom, you have a capital rotation. Well, what's going on is we go all the way back here on revolving credit, it's going to crash. And when you see that rotation crash out of credit and into other things, eventually out of the dollar and the bonds, when those break, you got the rotation into gold and silver. And look at this little cup pattern. Here's a cup, here's a rotation into a nice big bull market in gold, then a rotation into risk assets. And we come back down here and a rotation away from risk assets into gold. Okay, what's going to happen to gold when all this stuff busts? Dong, like that, because we see it every time. This is a long-term chart. It's beautiful. When people rotate out of stocks and dollars and bonds, you're going to see gold go bammo. Now they're doing it in other currencies. I'll show you one here in a minute, the pound, and eventually it leads to the dollar. Why does it always break last in the dollar? Well, in this current fiat system, the dollar is the king of the hill in terms of fiat currencies, the milkshake theory. The problem is when you look back further, like Sir John Globe's research, or you look at conjunctive wave cycles or the fourth turning, which that is based on, that you see these 80 and 250 year cycles. And every 250 years, the US being almost 250 years old since the Declaration of Independence, is you have this rotation out of the dominant currency. And specifically the last 80 years of that cycle when the dollar has been the dominant currency and then it crashes out of the 250 year nation state cycle. On the longer term, you see where the dollar's no longer going to be a reserve asset. And we saw in November on SWIFT, where for the first time since ever that I could find on any data, that less than 50% of international wire transactions or SWIFT transactions were conducted in the dollar for the first time in like ever. And then we also see, the central banks dumping dollars. And the World Gold Survey in 2023 that I've talked about 5,000 times, where the central bank said, we're going to go below 50% of global reserves in the dollar. What's happening? They're getting out of the dollar. So as things are crashing and they're simultaneously going out of the dollar, there will be a temporary boost in the dollar in the U.S. Treasury market, but that will force up rates to where we can't pay them. And then alternative systems have been into place where that dollar is going to crash and people are exiting out, which are doing already. But eventually it's going to go like exit out, and then waterfall, bam, because everything in finance is a what? Stair step down, waterfall. Okay, it's a stair step up, then a stair step, an evening out, stair step down, and then bam. That every chart over the long term looks like this in the asset cycle, specifically the currency cycle and the credit cycle, and that's where we're going. And then the opposite is that gold goes bam right up to the top. That's what's going to happen. And it may not happen tomorrow, it may not happen for 6 months, but it's going to happen. And all the charts I'm showing you are pointing to that. Moving on, gold versus 30-year real interest rates. Gold spot in white has gone up. 30-year interest rates, real interest rates have gone down overall. Now, interest rates are going to go back up, but this is a longer term chart. We're not just looking at the last few months of what's happened to real interest rates. But real interest rates are going up because of inflation, the difference between inflation and the yield you get on bonds, simple explanation. Well, what is that? That's where gold is breaking out versus what? The quality of the U.S. system, the quality of the bonds and the dollar. That's what interest rates are, inflation to yields, right? So this is telling you that gold, since late 2021, middle of 2022, has separated from the dollar bond U.S. Treasury complex and said, forget you, man. Why? Because the rest of the world is piling into what? Gold and not the dollar and treasuries long term. So even though we're getting a short term spike in gold and dollars and treasuries, long term, They've already separated. The rest of the world's already said what they're going to do. That's what this chart is showing you. Look at that gap. It's like a chomp, 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 chomp. You know, people are going to gold, not the dollar anymore. So people that say the dollar is going to last forever and blah, 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 this chart basically slaps you in the face and says, sorry, Charlie, ain't going to happen. Okay. You can see the correlation between gold and the real interest rates through the 2008 crisis and the 2020 health scare. But now they've separated because the world knows what's happening long-term to dollar. Yet another indication of dollar is the ultimate asset of value versus what? The treasuries and the dollar complex. Well, I told you I would say that gold has broken out to new all-time highs in a currency. You look at the pound. The British pound was a dominant currency before the dollar. And the British pound no longer being strapped to being the world reserve currency and just being a good currency indicator is surging to gold. In other words, gold is worth more than the pound because the pound is crashing and gold is going up. In other words, people are demanding more gold than they are pounds, okay? And pounds is one of the 5 or 6 major currencies that people trade in, okay? It's not the dollar, but it's a major one. And again, it was basically the world reserve currency before the dollar. People still think highly of it. People still think highly of the UK. And what's happening to gold and the pounds? It is broken out. You can see there's a cup, no handle required. It just popped. And then you have this flag pattern which called an upside move. Why? Because you had higher highs and higher lows in this flag. It was consolidation, higher highs, higher lows, consolidate. Once it got to that point, it broke out and went bong. So what's going to happen in dollars? Eventually that as well. That's basically going to be a similar pattern. Okay, so everybody wants gold, right? Everybody wants gold. I told you they're dumping dollars. They're favoring gold. We saw the breakout. What's another way they're doing it? Well, according to Bloomberg, Mali executing order to seize gold stocks at the Barrick mine. So Barrick has a mine in Mali. Authorities are executing the order on the 11th, 4 days ago. And essentially, and this is a pay article, I'm not going to get into it, but I've read other reports on this. And essentially, Mali's saying, yeah, we're going to take over the gold. You know, confiscation risk on some of these mines is raising. So if you're in the equity space, in the gold and silver sector, the miners, whether the junior miners, exploration companies, the mids, the majors, whatever, just be careful. I'm not saying this is going to happen everywhere, but confiscation risk goes up when you have major problems in the world, major global deflation, major currency issues, major interest rate issues, major all of those types of things. What's essentially going to happen is there's going to be confiscation. And it's going to be in places that are desperate to get their hands on the gold. How much gold does Mali officially have? Why are they taking over Barrick operations? Are they using the recent disputes just to take the gold, or are they really wanting Barrick to do something? Now, if you look at Indonesia and what they did a few years ago, or Freeport-McMoRan, the copper mine, which also produced gold and some other things, they basically went back to them and said, renegotiate the agreement. We want more of the value from this, and we want you to train some of our people on this so that we can, begin to build this industry ourselves and get more from these precious metals and things that you're digging out of the ground. Well, it seems like Mali's doing the same thing, but also they may just take the darn thing over and have the gold for themselves. Now, certainly they'll need Barrick to mine it. So I think what's going to happen is something's going to happen where Barrick and Mali get together and Mali just extracts more value because they really do need each other. But Mali's flexing here and saying, well, sorry, dudes, we need more value from this. And is this going to be outright confiscation where they do it themselves, or is it going to lead to a different agreement? I personally think it'll lead to a different agreement. But confiscation / tearing up the old mining agreements and doing new ones, which give more value to the jurisdictions that actually have the resources, not only gold, silver, rare earths, metals, whatever, bauxite, talc, whatever mineral you're talking about, but especially the precious metals, we're going to start seeing more of that. So just be cognizant of that if you're in the equity space. Doesn't mean it's going to happen everywhere. Doesn't mean every situation is going to be the same, but that risk is rising for the reasons I just explained over the last few minutes. Now going on to silver, as pointed out from Gold Charts R Us. Thank you so much, Gold Charts R Us. Silver is trading above its 200-day moving average. Now, this doesn't happen that often. You saw it happen in 2011. Silver popped to 49, almost 50. And you saw it happen back in 1980 when you had the big inflation event. This is and then you saw it kind of touch on it during the health scare in 2020, but not really stay there. Well, now in 2025, and the end of 2024 and 2025, you're seeing silver stay above its 200-day moving average. So people that are complaining, silver's never going to move, I get the frustration. But really, for only the fourth time in about 45 years, has silver either touched on or stayed above for any length of time its 200-day moving average. Really just kind of popped ahead and stayed there. And you can see that on this chart. Now, it has gone above its 200-day moving average quite a few times, but I'm talking about getting there, staying there, and having an uptrend. It hasn't happened that often. That's what it shows. So you're starting to see silver say, I think we're not going to fall back to that $22, $23 range. We're certainly not going back to 11 to 18. We're going to trade in this $28 to $32 range. And no matter what happens in the derivative markets, we're going to stay there. Why? Because worldwide demand. Why worldwide demand? Well, as you can see on the 𝙆𝙀𝙀𝙁 charts for the UK market run out of London, you can see this precipitous decline starting about 2 years after the health scare of silver. In fact, there was a precipitous decline during the health scare. It popped back up, temporary introduction. But because of all those mining deficits the last 3 to 4 years in terms of we're using more silver in industry and in investment and we're pulling out of the ground, you can see a massive crash in the amount of silver held in London. Now, there has been a crash in gold too. You can see a nice little crash from well over 300,000, probably 330,000 ounces to about 278-ish. But look at what the peak of the silver was. If you look at the peak of the silver about right here, it was 1,180,000 ounces in 2021. It has now fallen to 827,000 ounces in 2025. In just 4 years, you've seen over a 30% crash in the amount of silver that's come out of the London markets. Okay, and that's all silver. But remember, even those 800,000 aren't all free silver. A lot of that's held in ETPs, ETFs, other private transactions. And so not even all of that is free. So that's just a reduction in overall stocks. So why has overall stock reduction been happening? Because there's not enough in mine the last few years. So what's happening? Silver is going down in terms of inventories. And that's why silver price is starting to pop and stay above its 200-day moving average. But you say, Rob, that's only London. What about the rest? Well, if we go to the 2023 Silver Institute Worldwide Survey on page 27, you can see identifiable above ground silver bullion inventories. The best day we have, it's not perfect, but the best day we have shows, well, you've had a 28% decrease in the London vault since 2020, over 30% if you date it back a little bit further. The CME, or the American market, 16%, and the two Chinese markets, 7 and 9%. There you go. Less silver available, ladies and gentlemen. Less silver available. And if you kind of scroll up here, you can look, we'll go up just a little bit. There's been some increase in investment. I don't want to show you that. I want to show you, there's one more cool chart I want to show you here real quick. Well, that's exchange traded products, investor positions, turnover. Look at the turnover on the Shanghai. Look at that number, 91,037. And it's actually the SHFE and the SGE, the two Chinese markets. The one that's one's a little bit more physically, one's a little bit more derivative. They've smashed them together, but they divide by 2. So if you look at the average of those two Chinese markets, there's actually been more turnover of silver there than there has been on the than the COMEX, and almost as much as in the 𝙆𝙀𝐻. China has increased their silver trade so much. And that's part of what's pulling the price up. Because why? Because the silver prices are higher in China typically than they are in the US and in London. And so what does that mean? People are going over to China. Why are they going over to China? All on page 27, we saw the decrease in the inventory. So it's a great report. It's got all that other stuff in it. Page 27 is really the one you want to look at if you're looking at inventories. And there it is right there. Now, if you look at mine supply, here's the London Vault, silver inventory, CME. They've both gone down. Bam! On that chart at the bottom of that page, look at mine production. Mine production, here's where you get all the mine production. A few jurisdictions, a ton in China and in the West and in Latin America and then in Australia. And you look at producing countries, a lot of them are losing. Australia down 10% year over year, Bolivia down 7%, Peru down 7%, some of these major. Now you do have some increases in Indonesia and India, but overall, 1% decrease in the amount of silver production year over year. Less being produced. Primary silver mines, 27.8%. A lot of it comes from alternative mines. So if we have worldwide deflation and we're mining less copper, lead, and zinc temporarily, what happens to overall silver inventories? They fall. So a deflationary world economy also means that you could have a fall in what? Silver inventories. What's going to happen to silver as people suck it out through industrial demand, but also turn to it for investment demand as the rest of the financial complex, the Ponzi complex, crashes. What's going to happen to the gold and silver price? Dong. We showed you a gold chart. We showed you silver charts. We showed you enough information to give you the outline of the general story. Why do I bring the general story back? If you've been following me for any amount of time, you already know what the general story is. Why do I bring it back? Because it's 2025. And I said 2025, you're going to see things you've never seen before. And in the financial markets and elsewhere, this is the financial part of the podcast. I'm going to stick to finance here, and other episodes will go into other things. But just sticking on finance here, you're going to see a bunch of events you've never seen before start in 2025. That's why I brought you all of that data to show you what's going on. We're having credit rotation. Remember that North Star bad charts where we have that credit rotation out of bubble assets and into the metals, and the metal price goes ding. Okay. And we're seeing all the data leading up to that chart was showing you all the ways the credit is crashing. Credit usage is crashing. Bond rates are going up. The world is de-dollaring. All those things I showed you. This is the sum. It's showing you the rotation is coming. And when people rotate out these assets and things start to crash, what's going to happen both to demand and the inherent price of gold and silver when priced in these falling, crashing assets, specifically dollars? It's going to go dong. So it's going to go up not only in nominal terms, meaning as a dollar crashes, you could say gold and silver go up just because of that. In other words, as inflation increases, the dollar and silver price go up in dollars because, well, it makes sense. It takes more dollars, more inflation, right? Increase in prices. But also the demand is going to go up, which is going to spike the value beyond inflation. And we're getting closer to that moment that I've been talking about for the last 5 years, and where you're going to see gold and silver break away from just tracking inflation, and they're going to track the collapse of the dollar Ponzi system. They're going to surpass the suppression that's been going on in the derivative markets, especially the Western markets. All of the control of these markets is going to start to roll east into the BRICS nations, as well as like South America, Brazil. But the BRICS nations, but specifically the big ones, the new BRICS commodities market that's formed, that's supported by Dubai, Brazil, India, Russia, China, as well as some of these other nations. And you're going to, or the UAE, Dubai, you're going to start to see all of that happen, right? And it's all happening now. All the buildup is happening now. And when it happens, it's going to go boom. We're seeing the stair step down of these Ponzi assets, the stair step up of these other assets. And then what happens? Waterfall. Ponzi crash, boom. Waterfall up in the precious metals, boom. And that's when the revaluation comes. In other words, the reset is coming. The reset in prices. Now, the reset, if you talk to the elites, they want to put you on CBDCs. That's their version of the reset. And it's not only financial, it's cultural, political, all that stuff. But I'm talking about just a reset in prices is coming, and the collapse of this existing system is coming. That part of the reset is coming, and it's on our doorstep. And I'm telling you this so that you're aware, so that you know, okay, so that you can see what is going on, because you're running out of time, and people are getting frustrated, but stop being frustrated. We know what happens. And from a biblical perspective, we know what happens. Well, I'm not going to get into that on this episode. I'll just stick with the finance. We know what's going to happen. So if you're positioned correctly, you're going to survive. And to me, it's not about getting rich. You want to go get rich? More power to you. Go trade it and get rich, okay? Do the equities, leverage your, I'm not advocating that. But if you want to do it, you obviously can do it, no matter my warning. This goes out to the general public. It's just trying to freaking survive. If you looked at what was happening to the consumer in these charts, and I've been talking about for forever, I just want people to survive. Just freaking survive this. Have a little bit in precious metals to capture that loss that you're going to get, and everything else. Okay, if you believe all the data that I showed you. And again, I'm not a financial advisor, consult your financial advisor. That's my disclaimer. But this is what I see. This is data from all freaking over the place. This is a data review. What do you think is going to happen? You use, your reasoning faculties. Use your brain, decide for yourself. But it's pretty darn obvious to me what's going on and what's going to happen, and that we don't have a whole freaking lot of time left. And that's why I wanted to start the first in-depth gold and silver report on this note specifically, this way, to get you the big macro picture that's going to happen in sort of the medium term. And then next time we'll come back and do the gold and silver report. I'll go back on the COT report and all that stuff. and I'll give y'all a little, weekly data like I typically do, and we'll cover that this year. I ain't going nowhere. Told you I'm not going nowhere until we get the resolution of these gold and silver markets. So I'm still here in 2025, year 5 working into year 6, baby, and we're going to keep on trucking. So stay tuned to this channel. We'll give you what you need to know. And come see me out at the Houston Money Show, the coin show in Conroe, Texas, this Friday and Saturday. By the way, I won't be there Sunday. I'll be there Friday and Saturday. Come see me. Look me up. I'll be there. And say hi to you guys down in the Houston area, which I haven't, had a chance to do in the past at a conference or at a coin show. So come see me. God bless everybody. Hope that everybody receives us well. Love all you guys. Until next time, Rob with the Freedom Report.